So we'll just
hold on a second. Okay, it's okay. I can't record anymore, but somebody's recording. Yeah,
no worries.
Okay, sorry.
No, that's okay. No bother. Okay, so we'll just go in order as we got them. So we'll first question is from Javier Dominguez. So I will try and find Javier, and we will ask him if he wants to ask it himself. Okay, Javier, I think you're off mute now. Would you like to ask your question of David?
Hello, thank you very much. It's been lovely, the presentation. I would like to understand whether the decision is about financing a particular technology is taken only on the basis of the economics, or do you use an engineer? Shall the case that you are not an engineer, do you take an engineer to help you make the right decision?
Hi, Javier. Thank you very much for your question. So I think most of the investments that we've made are in proven technologies. So across all of the clean energy space, it has been proven technologies and investing in projects which are typically the economics are quite straightforward in terms of they tend to be backed by long-term contracts, or subsidies, or selling power, relatively straightforward, because we have what's really important is that we can meet our financial goals for our clients as well as the environmental goals. So what I'm not, I don't think it is my job is to finance very, very, very speculative early stage investments. There is absolutely a place for that, but it tends to be in, I would suggest, venture capital, where you're in, there's big tax incentives, and clearly it's higher risk, and you're backing less proven technologies. What I'm doing is investing at scale in fairly straightforward renewable energy assets, whether it's anaerobic digestion or onshore wind or offshore wind or solar. But it's basically financing the build out of proven technologies. There are some companies on the stock exchange that are involved in earlier stage technologies like hydrogen, for example, and I could invest in some of those companies, and I have looked at them. So that's absolutely could form part of the portfolio, but the areas that I was sharing with you are kind of, it's a different risk reward. These are long-term predictable cash flows. These are specific projects that we're financing with kind of very clear risk reward parameters, etc. And that's because I'm not an engineer. I don't need to worry about kind of trying to pick one technology. Hopefully that answers your question. Is that okay?
It does. Thank you.
Thank you for your question, Javier. That was great. Thank you. Okay, so our next question from Fraser to everyone. Okay, Fraser, would you like to ask your question? Hi. Yeah, go for it, Fraser. Yeah, good to go. Yeah.
Yeah, my question is really about the impact on those companies that people no longer wish to invest in. What does the investment decision actually impact on the behavior? Casey's probably addressed that in terms of the climate emergency and those energy companies that want to engage in that. But I suppose I'm thinking about some of the other companies that potentially are left behind, the dirty fracking and coal companies, the armaments companies, pornographers. What are they irredeemably bad? Is there no way back for them?
I'll jump in first, and then maybe David wants to jump in as well. Look, so divestment has very much been seen as okay, if you really disagree, divest, right? And I think what we as big institutional shareholders have realized, and you'll have seen this in the press with Exxon, is actually shareholders own the company. Like, we appoint the board and we appoint management. We vote in the board of directors every year. And so actually our most powerful tool is being angry, noisy shareholders. And we saw this with Engine One, who put in a shareholder resolution to eject company directors from the board and put in place climate friendly company directors. And so I think the narrative has moved on in terms of influencing companies. It's no longer stay invested or divest. It's now actually, hang on a minute, we own you. So stop doing the things that we don't want you to do and start doing the things we do want you to do. And I think that's a bit of a sea change in terms of shareholders really finding their voice. Are some companies irredeemably bad? I think it depends on how you define bad, right? So there's degrees of badness. There's like a legal badness, and then there's like just not very good badness. And I think an interesting area here is tobacco. So 10 years ago, maybe longer, no, it's probably longer because I think 10 years ago was 1990 and it wasn't. So maybe 20 years ago, when you looked at ethical funds, everyone was like, oh, screen out tobacco. You know, when you were still allowed to smoke everywhere, it was like, screen out tobacco because tobacco is bad. And now when we talk to our customers and say, you know, what do you want to screen out? Tobacco is like number 27, because they're like, well, you know, if you're still stupid enough to smoke, then that's on you. You know, if and a bad company can continue to sell bad products to stupid people if people want to be stupid. So I think there are varying degrees of bad, and that changes over time. And it changes with the different policy environments that are there. And then I think your final point on the divestment, does it make a difference? I think sometimes it makes a difference if you have a difficult conversation with the company beforehand. So for example, Legal & General sent out investor expectations letters to, I think it was 20 companies. You can find it on their website. It's not like secret knowledge. And they basically said, we think you're rubbish because of these 10 reasons. And if you don't fix these 10 things, then we're going to take our big shareholding out, and we're going to publicly disclose that we're doing that as part of their future world strategy. And so I think that kind of thing can make a difference, where you're really clear on, this is why I think you're bad, this is what you need to do to change. And you can use that kind of investor pressure and kind of public shaming to help companies change. And then there is kind of a really technical argument about, you know, if you have less shareholders and people aren't willing to buy your debt, it can drive up your cost of capital and things like that. But that's like a second order effect. If you're listed on a stock exchange, you're you know, just swapping one owner for another. So I think that's less effective. I'm going to stop there because I could just talk forever about this stuff and see if David wants to add something in.
Nothing hugely insightful, just to echo what Casey said, which is that these are quite complex and dynamic kind of issues, and companies are generally quite complicated. Yet I think the investment community is, I get a little bit nervous. There's a little bit of cancel culture creeping in, which is kind of almost like virtue signaling, or we don't invest in oil and gas, or you know, rather than actually thinking, well, what's the right approach? You know, it's, yeah, I get a little bit annoyed about that. But it's, you know, it's down to kind of, you know, subjective judgments. You know, I love smoking, but I can't in good conscience invest in tobacco companies because I know that they're killing people. You know, that's it. You know, I don't see enough. It's just a personal judgment. When I look at their ability to create zero harm tobacco, you know, nicotine products, I just don't see it being a big profitable business for them. So actually, from a financial perspective, I just see lots of risk, because I think less and less people are going to smoke. You see the younger folk did not smoke in anything like the same numbers that we did. And they don't have any divine right to be the winner in the vaping market or in any other new sort of technology. So I just see lots of financial risk. So it's you know, there's certain things that it's hard to argue for. So, you know, controversial weapons is one where I think is a pretty straightforward argument that, do I want to invest in companies that make cluster munitions and chemical weapons? No. You know, I think they're probably irredeemable. But again, it's complicated, because what happens if just 2% of their sales are in that, and, you know, 98% of the sales are in a different product line? So companies often do lots of different stuff. So where do you cut the thresholds in terms of exposure to bad stuff? You know, yeah, sorry, I'm not sure if that adds much.
It's all right. Thank you, David. Fraser, are you happy with that? You want to come back on any of those
absolutely.
points?
That was great. Thank you.
Brilliant. Thank you so much for your question, Fraser. Okay, so next up we have Andy Hinton with a question. Andy, would you like to ask your question?
Certainly. Yes, I'm a big fan of More or Less on Radio 4. The question concerns talking about the UNPRI system. And it seemed like a big number, but as they always ask on More or Less, is it a big number? How big is it compared to the remaining market? What sort of percentage of the businesses in the world are taking part in this initiative, which looks a very good initiative?
If anybody wants to grab into that.
It's a great question. It was my slide. So I really should know the answer, but I'm really sorry, Andy, I don't know. It's a great question. You know, what percentage of the investable, assets does that represent? I'm afraid I don't know. I do know that every significant asset owner I'm aware of is a UNPRI signatory. I would say it must now be the majority, but perhaps Casey has got a better answer. I'm not sure if you know the stats behind UNPRI membership versus the total investable market.
I don't, but I think we could Google it while we answer other questions.
That's a great idea. Thank you, Casey. Andy, thank you for your question. Well, we will get an answer for you, I think, at some point soon. Okay, so next up we have from Daniel. Daniel, would you like to ask your question yourself, or would you like me to do it for you, sir? Okay, no worries. I'll ask it then. That's fine. Okay, so the question is, how much of net zero is reliant on carbon offsetting? Does anybody have any sort of thoughts on that question? Any sort of experiences or exposure to net zero and any sort of links to offsetting?
I can jump in on the investor kind of pathway piece and my own thoughts on offsetting, which I think there was an analogy going around on, I don't know, some kind of social media platform where they did this thing where you could offset your affair. So they went around and interviewed people and they were like, so have you ever had an affair? And the people were like, no. And they were like, well, can I like offset my extramarital affair with the fact that you didn't have an affair? And I think that is like an example of the badness of offsetting, right? So we've got too much carbon emissions. We need to be thinking about cutting them. And then the offsetting needs to be like extraction and things like that, rather than, getting someone else who didn't have an affair to offset your affair. When we talk about net zero by 2050, one of the big institutions that helps us figure out what those pathways look like is the International Energy Agency. Now, up until about 18 months ago, the International Energy Agency produced pathways that assumed that we would have a whole bunch of magical technology that nobody had invented yet, and that we would be able to deploy that at scale. And so we had some really difficult conversations with the IEA and said, look, we can't have difficult conversations about the need to shut down coal mines while you're producing this magical thinking about, like all of the carbon emissions being offset by carbon capture and storage, when we just know that we're not going to get to that scale. So can you please produce some scenarios which are more realistic about the deployment of those technologies? And, to be fair, they have done so, and they've also made all of the data publicly available because they believe it's really important that everybody has access to this information. So what I would say is that from an investor's perspective, the best net zero plans have limited use of offsets and have limited use of the assumption that we'll be able to deploy at scale carbon capture and storage, because it's just unproven in the timescales that we're talking about. And where it is used, we should definitely be looking at nature-based solutions and the regeneration of biodiversity in areas where it's suffering, or actively incentivizing, let's pay Brazil to stop destroying the Amazon. And also there's one other point where some companies, so not to name anybody in particular, Shell, If you are like 10% of your market, but you say that you're going to plant trees over a country the size of Brazil, and that we only have one Brazil, and all 10 of your competitors cannot do that, then your climate plan is a busted flush. So yeah, there's lots of nonsense going on in that offsetting space.
Thank you, Casey, for that answer.
I was just
Sorry,
gonna-
somebody else want to jump in? Yeah, go for it, Stuart.
I was just going to add that I don't think it is exclusive to the net zero world. I think there's an awful lot of, I know David touched on it, greenwashing, whatever you want to call it. There's no doubt about it. You could just watch the telly and when COP26 was on, the increase in the number of adverts that were being shown for all these companies doing all these magnificent things. So I think that's, and I think financial planning world, investment world, we are no different. There's certainly, you know, you only have to look at your LinkedIn profile, every single company is doing something. So there's no doubt that it's, and that's not put us off, but we've certainly been wary of just steaming straight into it and saying, look how marvelous we are, and we've got all these amazing things. And I'm no doubt you could probably pick holes in the things that we do as an organization, from something as simple as the amount of paper that we use. So yeah, it is. I think that's, for us as an organization, has been the, let's do it right, rather than just doing it because everybody else is doing it and it seems like the right thing to do. So I think, you know, hopefully, you know, whether that will be filtered out over time, who knows? But I think that there is definitely a bit of that going on.
Brilliant.
No doubt about it. Just to sell something new.
Thank you, Stuart. That's brilliant.
Could I just?
Of course, David.
I think
Yeah,
it
yeah.
would be really tightly regulated, because the scope for it to be misrepresented or mismanaged is huge. I think I've got a meeting tomorrow with a potential investment trust that's going to be, you know, investing in carbon credits, whatever, and it makes me nervous, the financialization of kind of offsetting. You know, the contrast actually with some other positive examples would be there's a property investment trust we own managed by Aberdeen Standard Life, and they've committed £7 million to, as part of their net zero plan for their portfolio. So this is offsetting the residual emissions in their portfolio of buildings. They're doing everything they can to reduce the, you know, the underlying emissions, you know, whether it's solar panels or heat pumps or insulation, etc. But there is a residual, you know, carbon footprint of a portfolio of buildings, and they've invested £7 million in a forestry, a reforestation project in Scotland. And that's not going to generate a financial return, but it is going to offset the you know, through carbon sequestration. And that's kind of, you know, as Kaz mentioned, like kind of natural solutions. That's exactly what kind of feels real to me. But again, it's only real so long as they don't then get, you know, sell off the credit they get to someone else, and who then uses it as an offset. You know, and there needs to be a really strong rules around that. Clearly, the scope for abuse is pretty high.
Yeah. Okay, brilliant. Thank you, David. Appreciate that. Okay, moving on to our next question from our very own Adam Price. Adam, would you like to ask your question?
I've actually forgotten what it was. Yeah, it was to Casey, because you mentioned that you did actually invest less in Exxon, and I think you've answered the question, because I was just asking, what do Exxon know that you did that? Obviously they do, and what is their response?
They probably don't, because we have less of an exposure to the US market. So and we're not, you know, a BlackRock or a Fidelity. We won't show up as one of their top 10 shareholders. So they probably didn't notice us kind of moving away from Exxon and towards a better company. What do they think of that? Maybe they are a better bet now that they've got more kind of climate friendly directors on their board. So maybe we'll need to revisit that decision. But yes, some of the very, very big companies just wouldn't notice. A small player with 184 billion, they'd be like, they just wouldn't notice us at all. I think in my mind, there's probably a tipping point for companies. I don't know what that tipping point is. Like everybody says, divestment doesn't matter, but like if everyone divests, then surely that matters. But I don't know what that tipping point is. I'm sure there's somebody doing a PhD on that somewhere that I could ask.
Brilliant. Thank you, Casey. Thank you, Adam. Okay, our next question, again, from our very own Alison Stewart. Alison, would you like to ask your question of Casey?
Yeah, hi, Casey.
Hi.
You mentioned about having the plans, and obviously that's really quite important for companies to have plans. But we also know from our local authorities that there's tons of plans and policies, and the real devil is in the action. So how much time do you give them to get to actually the fact that their plans are working, and to what extent? Because I've yet to see really an oil and gas company get to net zero in relation to their production of oil and gas, any of their plans. In fact, what I generally see is an awful lot of diversification with the oil and gas production still keeping on going the same level. So how does that help to reduce? Can give me a little bit more about that kind of encouragement. At what point do you just get rid of them?
So, okay, so there's a lot in there, right? So if we look at now I wish I could pull up multiple screens. I wonder if I've got it open already. Do I have it open? No, I don't. Okay, so if I have just completed some analysis on our top 10 holdings as at the end of the end of 2020 versus the end of 2021. Because we're just about to disclose the change in our carbon footprint of our financed emissions over the course of the last year. And what we can see in those emission profiles is that the reported emissions, and this is only scope 1 and 2. So for those of you who are familiar, scope 1 and 2 is the stuff that you generate through your operations. For Shell, it doesn't include the emissions from people burning fuel in their cars. So clearly scope 3 is really, really important. And let's just put a pin in the fact that we don't have that number. What we can see is that some of the very big emitters have been investing in energy efficiency and that their carbon numbers are coming down. But much like a very, 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 very fat person, the first few kilos are easy. It's the last few kilos that hurt, right? So you can do as much energy efficiency as you want, but if you're still, if your core product is still gas or fuel for cars, then you're never going to lose those last few kilos. So on the point of, are we seeing them transition? No, we're not. And that's why Shell was taken to court in The Hague, and they were told that their climate plan was insufficient. And it's why I'm glad we voted against it as a shareholder. Because again, they're doing this thing of, well, the policy environment hasn't told us that we need to do it. Our shareholders haven't told us. Unless everybody else starts to move, then we would have a competitive disadvantage. And their plans are very much reflective of the policies that have been put in place in governments, which, you know, even the rhetoric coming out of the UK government, oh, we need to maximize the North Sea. So the companies are operating in the world as it is. It's why one of our big levers as a big institution is to engage with policymakers and say, you need to set the right policy incentives to drive this action. If you want companies to shift their behavior, you need to shift their incentives. And then your final question, when do we call time, right? So that is a very interesting question. I think for different investors, it will depend, because some investors might have a buy and hold portfolio that's backing a liabilities profile. And so they will buy and hold, and they will try not to divest. For us, we set out some clear criteria. So we will engage with our biggest risk companies on whether they are willing and able to transition, and then are we seeing progress? So there are some companies who are willing but not able, and there's some companies who are able but not willing. So they have to be both willing and able. And what we see, and this is, I guess, particular relevance for Aberdeen, there are some companies that should just die a dignified death. And what I mean by that is, for me as an investor, a dignified death can be a safer investment than a company who tries to transform itself. So most massive big company transformations, I think it's more than 50% of them fail. So if Exxon tries to transfer itself into a renewable energy provider, or if Kodak tried to transfer itself into Apple, that wouldn't have worked. So do we see the oil and gas companies starting to carve out actually two separate businesses? One business line that starts to focus on renewable energy, and another business line that says that we've got these oil and gas assets, but we're going to go into a managed decline, And we're still going to be a good investment because we're going to pay out healthy dividends, and there are investors who want dividends in their portfolios because they want to generate income. But this is our managed decline plan to 2050. That is the type of conversations that's happening in the rooms with big institutional investors and big sector groups. How are you going to manage the decline in your sector? Because actually not all of you are going to be able to transition. You're not going to have the internal capacity and capability. But I don't think we're quite there yet. For us, the assessment period runs through to 2030, but we will divest before then if there are very clear signs that they are unwilling, unable, and a financial risk to the portfolio.
I mean, because we do have a schizophrenic government, or both our governments schizophrenic. We have the MER, the Maximising Economic Recovery on oil and gas. At the same point, saying we're getting to net zero, need to have a transition. So that there's little kind of impetus for companies to transition, but diversification, yes. But that's just like to keep the market happy, almost.
Yeah.
So what you're saying, yeah,
is where are you spending your capital? Because fundamentally, as investors, we're giving you capital. Are you wasting it? We don't want to see you spending capital on stranded assets. We want to see you spending capital on building capability for the future, or give it back, pay it out as a dividend. Don't waste money. And I guess the wonder kid in this sector is Ørsted, right? They've kind of pivoted their company from being oil and gas to being a renewable energy provider. So it is possible. And you can go it alone and do it. But I think we really need that kind of policy environment. I think as a group of investors, we had a discussion today actually about, should we be sending an open letter to the government about the rhetoric around North Sea, and that we just shouldn't be doing that. But we thought, with the war in Ukraine and oil and gas insecurity, it was maybe a read the room moment, and now is not the time to be having that conversation, but it's definitely a conversation that needs to be had.
Okay, brilliant.
Probably should have said that on a recorded Facebook thing. Sorry. Redact.
You have the right to redact. Yes.
Casey, if you're serious about that, let us know.
Okay.
Think about it.
Absolutely. Yeah, you can just ping us over an email later if you want, Casey. Thank you, Alison, for your question. Thank you, Casey, for your answer. Adam, I believe you had something you wanted to come back on and ask the room.
I've got two questions coming up. Are we over to me already? Okay.
We're over to you already, sir, yes?
Well, no, my question it's kind of very similar to Alison's, only not as eloquent really, but I love these climate cafes because we get excellent speakers, and in October we had the head of sustainability for BP speak to us, and we had a very impressive talk about what BP are doing to go greener, and it really was impressive. But at the end of the day, they're spending 10 times more money on oil and gas explorations. So I think Casey's frozen. In my screen, Casey's frozen. But anyway, the question really, maybe more to Casey than or anyone. Yeah, is what a company like BP doing enough? It seems like it's so urgent that we pivot away from oil and gas, that spending 1/10 of your investment in green isn't enough.
It's a great question, Adam. And we're shareholders in BP, and we've spent quite a lot of time assessing their strategy plans. And I must admit, I am actually pretty impressed with what they are doing. And I think they've put together a pretty significant but credible transition plan whereby they are genuinely reducing their oil and gas production meaningfully over the next 10 years. I think it's 30 or 40%. And they're more and more of their capital is going every year. They're absolutely pivoting quite meaningfully towards transition businesses, whether it's solar or offshore wind. They were one of the biggest bidders on the latest round of offshore wind, as well as things like EV charging, etc. You have to take this with I don't feel sorry for all companies, but we're all complicit in this. A lot of people are saying, "Oh, it's up to you, oil companies, to fix all this." Well, we're the people driving cars. We're the economy that thought heating our homes with gas was the right way forward. it requires a lot of a joined up approach by all stakeholders, and government have got a really important role to play. You can't say, oh, we're going to stop people being able to have gas boilers when the alternative, which is electricity, because by the way, we can't have air source heat pumps in the oldest housing stock in the world. I mean, it just isn't going to work. So you're basically saying to everyone, oh, by the way, you're going to have to move to an electric boiler. And until recently, that was what, 2 or 3 times more expensive? Who's going to pay for that? Again, who's going to be what about fuel poverty? Is that the oil company's fault? And we're having this geopolitical huge thing at the moment where you've got the biggest supplier of oil and gas globally being at war with the West. What about energy security? If we stop producing oil and gas before we've transitioned, then you have all these externalities, all these unintended consequences. So I think BP in that context have plotted a very brave path, and they're starting to actually flesh it out in sufficient color. So for me as an analyst, it's quite difficult because I've got no idea what the returns are in some of the investments they're proposing. But what I do know is I've been investing in oil, the oil majors for almost 20 years, and they've made terrible returns. Oil, they made hardly any money when oil was 120 bucks, and they then made almost no money when oil was at 40. So it's not like they've been an amazing investment over the years anyway. I mean, the return on invested capital is terrible. They're struggling to get to a double-digit return with oil, where it currently is. So actually, a much lower risk, possibly lower return profile by investing in, subsidized renewables or just lower returning renewables. Who's to say that turns BP into a worse investment? Arguably, from a financial perspective, it's maybe better from a risk-adjusted return. And also, if you price carbon properly, clearly it's better, because we all know that oil and gas is incredibly bad for the environment. But unless we have EV charging rolled out and significant investments into a credible plan for the heating infrastructure in this country, I don't blame oil companies for that. It needs a joined up government approach as well.
Brilliant. Thank you, David, for your answer. That's excellent. Thank you. Adam, did you have
frozen.
Oh, sorry.
Can you still hear? No, I think I've frozen, but you can. Can you still?
We can still hear you, Casey. Yeah,
definitely.
Absolutely.
I can see that I've frozen in not the most photogenic of poses. I totally agree with David. And there is a huge thing to be said. I remember having a horrifying moment in the initial run up to COP26 before it was postponed, where we had government officials being like, oh, the market will solve this problem. This kind of idea that the market has a moral compass is false, right? So we need the regulators, we need the policymakers, we need global agreement on carbon pricing, on the right incentives. We need to even just stop incentivizing the bad stuff would be a really good place to start, and then start incentivizing the good stuff. And I think there's also some horrifying statistics out there. This incrementalist approach, if you've started reading I think it's like 4,328 pages of the new IPCC report. Honestly, the scientists need to get some, people with crayons to help them with their reports. They've finally started talking about, it was all about sustainable development. They've finally started talking about the fact that the reason we're facing into this problem is because of our ongoing unsustainable consumption and production patterns. And that's what needs to change. It's not that we need more sustainable development, it's that we need to stop the unsustainable development, production, and consumption. And I think that is a really difficult conversation for us in the developed world. It might mean we need to have less. And I think actually during COVID, what we saw was actually sometimes having less means you have more. Having less stuff means you have more time. We've just kind of measured the wrong things. I've now gone all philosophical, and we were supposed to be talking about BP. So I'll shush.
Thank you, Casey. That's brilliant. Thank you for your answer. Okay, so Adam, I don't know if you wanted to come back on any of that. Are you quite happy with your question being answered? I'm
very happy with those answers. I think it's a conversation we have to have. We have to talk about this because it can seem very black and white, but obviously it isn't.
Yeah, for sure. Brilliant. Thank you, Adam. Okay, so we have a question from Rachel. Rachel, would you like to ask your question, or would you like me to do it for you? Okay, no worries. Okay, so on a practical note, Rachel works for the NHS. Can she control where her pension is invested? As an individual citizen, what can I do? I guess just to very briefly say that Stuart talked about it very early in the day is, I guess the most important thing that a lot of people can do is ask the question, where is my money invested? But in terms of the specifics for Rachel's questions, guys, does anybody want to jump in and provide any sort of guidance and any sort of experience, especially from an NHS pension point of view?
Yes, the NHS pension scheme. It's a did I use the word beast? It certainly is. Yeah, not especially. I guess that's probably not the answer that you wanted. It's such a huge, enormous pension scheme that you, as an individual, you have very little control over where your money is actually invested because of the structure of it, and the structure of having pension scheme trustees who administer it. And I guess there's probably more information that you can. I'm not an expert on the NHS pension scheme deliberately, because it is just a huge beast. But certainly, I'm sure you can find more information about it. But in terms of influencing the investment decisions of your own pot of money, there's not an awful lot that you can do about it. I'm sure there are that you can be, maybe, I don't know how easy it is to become a representative of the scheme locally. You might be able to do that, and that you'll therefore have some degree of input to it. But in terms of any actual practical day-to-day and what you very little control, yeah. I'm afraid.
Yeah, no, that's good. Thank you, Stuart, for taking the time to talk us through that.
Can I just jump in there?
Of course you can. Yeah.
The NHS pension scheme is not a funded scheme. It's a pay-as-you-go scheme. There is no fund.
So
Thank you, Jim.
in the DC version of the NHS pension, so a self-funded pension.
We can follow up.
Not my case, but the main NHS pension scheme is a unfunded pay-as-you-go scheme.
Yeah, but there has still, it's unfunded from an individual, but people are still members of it, and therefore still have an entitlement within it.
Yeah, they have a contractual right to a pension, but the pensions that are paid out in year one are paid by the contributions paid in year one. It's like the state scheme; it's a pay-as-you-go scheme.
Yeah, but still,
but it is a defined benefit scheme.
Yeah, absolutely defined benefit scheme. Yeah, but there will still be investment decisions made behind with the funds that for the members.
No.
Well, it says on Google. Google says funds from the scheme are not invested. It is an unfunded contributory public service occupational pension scheme. The fund has no assets to speak of, and therefore no investments. All pensions in payment are paid out of current resources on a year-by-year basis, and that is from https://FAQ/nhsbsa.nhs.uk. There you go.
Brilliant. Thank you, Casey. Yeah, fantastic. Thank you so much for that.
Google is your friend.
Other search engines are available.
Yeah, and the answer is still
Sorry,
no.
yes. Disclose. Yeah.
And the answer is still no.
Brilliant. Thank you, guys. I appreciate that. Okay, so I guess there's a great point in the chat here from Adam, speaking to Rachel as well about joining pressure group, who might have the ability to influence decisions as well. So yeah, that's definitely one of the sort of practical things that can be done, as well as asking where your money's invested. If you don't like it, have a look for opportunities to get involved from a pressuring perspective. Okay, so guys,
Kevin, I had another question.
Yes. Oh, did you? Okay, go for it.
Well, I think this one's quite important for people who want to sort of some take-home messages. So this is asking if there's anywhere we can find out about the quality of investments as green. So it is a massively frustrating thing for anybody who tries to walk through life becoming greener. Is it so hard to find out what is a quality green product out there, whether it's a banana or a yogurt or an investment. So is there somewhere where the public can go, or do we have to go to advisors for that kind of insight into the quality of the sustainability of a pension? or an investment?
I mean, you don't have to use an advisor. I mean, you know, I'm not gonna say you don't use an advisor for obvious reasons, but you don't have to use an advisor for any degree of advice or that you need. You know, and there are lots of websites out there. I guess the challenge is there isn't a central one. There's not like a one that you can go to and find all the information you're ever going to want to know. The nature, unfortunately, of financial products is that invariably someone at the top of these adverts is trying to sell you something. So there isn't a kind of, I mean, there's a website called Unbiased. Now, Unbiased is primarily used as a way of people identifying or putting, you basically can input some information and it goes out there to lots of financial planning firms and they can pick up your inquiry and get in touch with you and arrange a meeting. And there's a lot of information on there about financial products. There is, I was looking earlier, there is some good information on there about ethical and ESG and fund investing. And it is, by the nature of the name of the organization, it is unbiased. So there's no incentive of them to sell you something. So you can look at that. You know, all I would say is, I say to a lot of people that it's a bit like, if you Google your medical complaints, invariably it doesn't necessarily end well. And I would say the same with financial products. If you Google something, it invariably gives you the answer that they think you want to hear, and it doesn't always necessarily end well. So I would say that getting advice doesn't suit everybody, and not everybody will want to do it for whatever reason. But I think, you know, like I refer to the medical issue, invariably you will probably get a better outcome.
Right. That's great.
So I was just going to, if I may just follow up on that.
Of course, David.
It is one of the great challenges is trying to, the investment industry has come up with an explosion of terminology to cover this whole area of sustainable, responsible investing. And everyone has a different approach to it. And actually, I like that plurality of opinion because I don't think I think these issues are so complicated. I don't think you come up with one simple, really defined, you know, clearly defined set of principles as to what a good portfolio looks like. But at the same time, that means that investors are faced with a really complicated set of options. There are good resources out there, as Stuart mentioned. I would think that the retail investment platforms, the likes of Hargreaves Lansdown, AJ Bell, etc., they will probably have some decent literature in terms of giving you examples of the terminology or the different options, etc. But there, you know, it's not. Unfortunately, a lot of financial stuff it should be straightforward. In this particular example, the whole area of sustainability is not, and we seem to have invented a lot of complexity. So I don't think there is a simple solution. And it may be that you know, a good advisor you trust might be able to help you navigate through that. You know, or you can just spend a lot of time trying to work it out for yourself.
Brilliant. Yeah, no, great. Thank you, David. Casey, you wanted to jump in there, Casey? Yeah.
Just one thing to maybe look forward to. I don't know if it will help that much, but much like we have, you know, when you go to buy food in the supermarket and it has those labels down the bottom and it's like red because you're buying pizza and it's got loads of sugar and fat in it and stuff. So the FCA is now looking at consumer labels for funds. So there is already a kind of labeling regime in the EU, and there will be a UK regime. I think they're hoping to launch that by the end of the year. I don't know if they'll be successful in doing that. And I sit on that advisory group. So what they're looking at is having different categories that help consumers understand what different investment processes. So as Stuart talked about at the start, do they exclude things? Do they pick things specifically to invest in? Are they purely sustainable? Do they invest only in sustainable companies? Are they transitioning? So are they investing in those companies that are enabling the transition? Or are they excluding things based on certain value-based criteria? Or are they specifically looking to invest in certain sectors of the economy? Hopefully that will become regulatory requirements and overseen by the regulator and reduce the potential for greenwashing, because at the moment people are just saying whatever they fancy. So having a standardized labeling regime that is easily understood by the end consumer, I think is key. And the FCA are doing quite a lot of consumer research on the understandability, I don't know if that's a word, of the different labels that they're proposing. So that's one to watch out for that might help navigate all of the different funds that exist out there.
That's brilliant. Thank you, Casey, for that. That's great. Well, Mr. Chairman, I think we're quickly coming to the end of our time together. I don't know if you want to take over from now.
Yeah, I will. I mean, the timing's absolutely brilliant. Look, Stuart maybe mentioned this right at the very beginning when he said that pensions and investments is not everybody's favourite subject or the most interesting subject, but my word, you three have made it so. I thought it was amazing, a real insight into something I'm speaking for myself, know rather little about, and something that you also demonstrated in the way you presented this is critically important to our ability as a world to get to net zero and solve this mess that we've got ourselves into. And the really nice thing about what you said, which is something we pick up a lot in these climate cafes, is there are messages, positive messages about change that is happening very rapidly. So it gives us some hope that these changes will make a difference. Whether it's fast enough or not, I don't know. So I thought it was brilliant. I would like all those people who are still in the audience to try and unmute and give a quick clap if you can. So can everyone unmute? Do they have the ability? If you can unmute, and we'll do a little round of applause to say thanks to the speakers. All right.
Thank you, guys.
And that is it, folks. I mean, 2 hours of your time on a Tuesday to listen to talk about pensions. I think you are the lucky ones. So, and we're very lucky to have these speakers. So, thanks very much, speakers.
Thanks so much, everybody.
Yeah, everyone. Good night.
Good night. Thank you.
Thank you.
Take
Cheers.
care.
Thanks for listening.
Bye-bye. Cheers.
Cheers.